making use of your home equity when you're down to limited super and on the pension makes sense to increase your lifestyle. What does a reverse mortgage cost? The cost differences can be quite large, and it depends on how much you borrow, how you take the amount that you borrow, the impact on your inheritance, what happens to the remaining equity that's going to be left over for your heirs.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day and welcome to another episode of Perth Property Insider. I'm your host, Jared Mann. And today we're looking at using your home equity to fund your lifestyle. Is it a good idea or is it a hidden trap? And this is relevant to those that are heading into retirement. And if you're a listener that's not that old, you might have parents or grandparents that are going through this situation. And that's what's prompted me to record this episode, because I've had a few clients getting into that stage and asking me questions about it. And my parents have also had me helping them with researching the options and looking into using their home equity to fund and push up their lifestyle on top of the pension that they currently get. And that would just allow them a few extra niceties and indulgences to enjoy their life while they can before they get too old. And it doesn't matter about taking a holiday if you don't have your health later in your years. So it's really for those that are 60 plus. And I'm going to talk you through some of the options available to make use of your home equity. Now, let's take a step back for a minute, because how my parents and many people sort of get down to looking at this as an option is that they didn't do very much investing. I sort of got them into it late in the game, but didn't have time on their side for compounding to really work hard for them. My dad had his own business, so he didn't put aside very much super. For the times that he was an employee, he had super put away, but for the majority of his life, he didn't put super away. So I think going into retirement, he had a bit of savings in, and he'd packed a fair bit into super, but certainly not enough to last the entirety of his retirement years. And they did downsize their house, which enabled them to put some more money in. But they're finding that that balance is dwindling, and they're looking at the asset that they've got in their home and thinking, what options exist for us to use some of this, and what are the implications, I guess, now and in the future. So let's start by looking at what is a reverse mortgage. It basically allows you to borrow money using the equity in your home as security. And if you're at age 60, the most that you can likely borrow is somewhere between 15 and 20% of the value of your home. So this is only obviously going to work if you've got your debt down to below that and can make use of, some of the equity then. And as a guide, you can look to borrow an extra 1% for each year that you're over 60. So at age 65, you'd be able to potentially borrow 20 to 25%. So they let you borrow a little bit more the closer you are to potentially passing on, I guess, and them getting their money back. Well, the minimum that you can borrow varies, but it's typically about $10,000. Now, depending on your age and the lender's policy, you can take that amount either as a regular income stream, so to prop up your other money that you might be getting from a pension or from your super or from rents from properties. You can take it as a line of credit, so just draw on it when you wish. You can take it as one lump sum, or you can take it as a combination of all of those. And how it actually works is, and the main benefit is that you get to stay in your home and you don't have to make repayments while living there. So the interest that they charge on the loan compounds and it's capitalized over time, so it gets bigger and it adds to the amount that you borrow. So it's not going to affect your lifestyle along the way. And the interest rate is likely to be higher than on a standard home loan in most cases. So that's worth noting because of the bank's not getting it now. They're basically getting a higher interest rate because they receive it later and they get to compound that interest. It's like compounding working the other way for against you. But keep in mind that the balances that you're looking to take out are still relatively low compared to the overall value of the property. Now, you repay the loan in full, including that interest and fees, when you either sell your home or you move out of your home, or when your deceased estate sells your home and you've passed on. So those are the sort of trigger events for it to be paid back. And you may be able to make voluntary repayments earlier if you wish, and you may also be able to protect a portion of your home equity from being eroded by the loan. So that could be good if you've worked out some numbers of what amount you want to have left to pay for aged care or to pay for other things. So what does a reverse mortgage cost? Well, the cost differences can be quite large, and it depends obviously on how much you borrow, how you take the amount that you borrow, whether you're taking it as the lump sum or as a lump sum is going to cost more due to the compounding interest that you'll pay over the time. Whereas if you take it out steadily, you're only going to owe money on the balance on the payment that you receive that point moving forward. And obviously the big one to look at is what are the interest rates and fees and some of those fees can be quite hidden. So you need to look into the loan establishment fee, the ongoing fees, the valuation fee, and then any wrap up exit fees towards the end. And then how long you've been in the loan. Obviously the longer, the more that the loan interest is going to capitalize and sort of compound against you. So over time, your debt's going to grow, your equity that you have will likely decrease. But when you do some conservative figures, you can also allow for an increase in the value of your property and using a conservative amount and making sure that you do your projections and see that you're still going to have enough for the next stage that you move into after needing this loan. So your lender or broker must go through those reverse mortgage projections with you, showing you the impact on your home equity over time. And I'd suggest that you get a copy of that and go away and speak to a financial planner or a financial advisor just to go deeper and make sure that you've got all things understood. Purpose of this episode is really just to get you aware of this, that this can be done, and some of the things to look deeper into if you're interested in pointing people in the right direction. So there's also negative equity protection that reverse mortgages after the 18th of September 2012. It's now a requirement that you can't have negative equity, and where you end up owing more to the lender than your home's actually worth. So there's a number of protections in there to ensure that that's not the case. If you took out a reverse mortgage before this date, check your contract because it may not include that negative equity protection. Now, one of the things that I really wanted to run through, which I thought was a really brilliant option for those that qualified and were in this boat, was something called the Home Equity Access Scheme. So this is provided by Services Australia and the Department of Veteran Affairs, and it lets eligible older Australians get a voluntary, non-taxable fortnightly loan from the government. So I think it's a really great option that the government's providing, and this is really to help supplement retirement income. So how the scheme works is that, like a reverse mortgage, the loan's secured against your real estate. You can choose the amount that you get paid fortnightly, but the combined pension and loan repayments, loan payments that you get cannot exceed 1.5 times the maximum fortnightly pension rate. So there's a number of restrictions. Well, the biggest restriction there is on the amount that you can receive. So end up with about 50% more than the maximum fortnightly pension. So 50% extra is still a lot that can change your life a lot and allow you to do extra things, but it is capped at that. You can also get an advance payment via this loan option, and I believe you can have up to two lump sum payments per year. There is a maximum amount of loan that you can borrow over time, and it's based on you or your partner's age and how much you offer as security for the loan. So I was pretty surprised to see that with this home equity access scheme, the interest rate that my parents have been quoted was 3.95% at the time when typical home loans are going to be around the 6.5%. So a good 2.5% less than the interest rate that the average borrower is paying. And when they were looking at sort of conservative projections, they just allowed a growth rate of 3%. And they were sort of looking at supplementing not that much extra per year, but the extra that they were getting really can help them enjoy life a lot more. So interesting. In their case, the loan maxed out after 18 years, and that sort of took them through to their, my dad being, mid 90s odd. So now there was a couple of criteria for this. So you and your partner had to be of age, pension age or older. You need to get or be eligible for a qualifying pension. So you actually have to be on the pension. So really this is for those that don't have their assets and investments to, provide for themselves when they get down to this point. And you and your partner obviously have to own real estate that you can use as security for the loan, and a number of other conditions associated. So go through them all. Now, when we compare this home equity access scheme to a reverse mortgage, look, there was a number of significant benefits and also trade-offs. So you had to be 67 years old or older for the home equity access scheme. When for reverse mortgages, you typically have to be 60 years or older. The loan amount was capped at that 150% of fortnightly age pension payments, whereas you don't have that cap on traditional reverse mortgages. You had more flexibility on traditional reverse mortgage as to whether you got your payments in a lump sum or regular income stream, whereas with the home equity access scheme, you get a maximum of 2 lump sums per year, and you have fortnightly installments. And some of the interesting other things is that obviously with it being provided by the government and you needing to be on the pension, it doesn't qualify for the assets test under the home equity scheme, but there is some of it does count on a reverse mortgage towards the assets test with Centrelink. So just worth making sure that this is not going to go impacting any of your other, Centrelink or pension payments. But in the case of the home equity access scheme, it doesn't apply to the assets test or the income test that they look at. So definitely worth going deeper with your financial planner and all of that. Now, some of the benefits then, really to summarize, is that a home equity access scheme has more stringent criteria to qualify and more stringent requirements for how you get paid, and less flexibility really all round. But the overall loan interest is going to be significantly less, and so a better option if you don't want to run up as many costs and have, I guess, more left over when you eventually do pass away, or you change down to your next stage of things from that family home into where you're going to live next. So overall, a cheaper option with the home equity access scheme. Now, let's go through some of the potential drawbacks and considerations. So you've really got to think about the impact on your inheritance. What happens to the remaining equity that's going to be left over for your heirs? I mean, in our case, I said to my parents, don't worry about leaving anything for us. You just do what's right by you along and enjoy yourselves while you still can. But in some cases, you may want to be planning out what you are going to leave to your heirs and making sure that you're still going to be able to achieve those goals. You need to look deeper at the interest rates, the fees, and how they're going to be accumulated over time. So that's definitely one of the drawbacks. The power of compounding sort of works against you, but you've also got your house growth hopefully compounding in the meantime too. So you're never going to be in a negative equity position, and you've got that protection as well that's built into it. Obviously, there's eligibility. So you're only going to be eligible when you get to sort of 60 years and 67 years for the home equity access scheme. So if you do want to have choices and retire earlier, really you need to be self-funded and not, and have the investments behind you to achieve that. You don't want to start dipping into your home equity too early either, because the other thought that I've had is that life expectancies are going to keep increasing. Who knows, we might be living up to 120 140, who knows how long we might be living. I'm really big into longevity, as you might have heard in one of our previous episodes. So I think you just need to be mindful that even though they allow you to have the loan for 18 years, and in my dad's case, mid 90s, with the advances in medical care and technology, he may still be around and then have to, look at either downsizing or changing out of this accommodation to repay that loan at that point, and sort of being forced to do that if he's still around. Hopefully he is. So some other key factors for homeowners to consider is to look at your long-term plans. How long are you going to stay in this home? And if you're going to be there for a while, then it's sort of very set and forget. But if you are going to change over, you need to look at how much you're going to be left with when you're going to change. If you're going to sort of stay there till your end days, hopefully, then, it doesn't matter as much what happens after you've passed away, because you can't take the money with you unless you've got plans for your heirs. I'd definitely look into your overall retirement planning and make sure that you consult a financial planner, and also think about the market conditions and regulations that are going to be in place. So obviously there's a big role that interest rates have. Read the sort of finer print as to how this interest rate changes and what it's indexed to, etc. And consumer protection measures may keep changing in this reverse mortgage space. So check out what the most current regulations are when you go to take out a loan of this type. So finally, I think, making use of your home equity when you're down to limited super and on the pension makes sense to increase your lifestyle. But I think you need to do it conservatively. And I think this home equity access scheme really does sound like a good option, especially with the lower interest rate and still having some flexibility on 2 lump sum payments per year, an initial lump sum. And for me and my parents, I thought it was a bit of a no-brainer, because, even if you do live longer, you want to still have your health to enjoy things and live the lifestyle, a bit of extra lifestyle while you can. And in their case, it's going to allow them to do that. So I thought this would be good to share if you've got any parents or grandparents or yourself are going through this. If you've enjoyed this episode, do like and share it and post a review. Always appreciate reading those. Thanks for tuning in, and I'll catch you on the next one. Bye.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.